evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo. Now, the video for the 14th of December here in 2022. It's all about the Fed. It's a Fed day, and they raised their overnight interest rate, the Fed funds rate, by exactly what was expected, 50 basis points, or a 0.50 hike. And they raised where the market went down, and went down hard on the initial announcement was that the forecast for the Fed funds rate is higher. And it's going to be above 5%, at least in terms of the projection. So that alone, even though rates were not 75 basis points as they have been, the Fed funds rate probably will, if not certainly will, continue trading higher throughout the early part of 2023. So that's where we'll pick up tonight's video. But looking at the intraday chart, just for a quick reference, the market was flat. That typically does follow the Fed day, which is not a lot before the announcement, a little sneak to the upside on the pre-announcement. And there it is. We, the Federal Reserve, have chosen to raise rates by 50 basis points, and the market, at least in the S&P, down 90 points. That was your option-based expected move for the most part, which gave it a target just under 4,000. Nonetheless, we are seeing the same logic and the same velocity in the NASDAQ, which is our tech-heavy sector. So lots of volatility, but that will be the headline as you digest the Fed announcement and Chair Powell's press conference. And that did put pressure on the equity market, which continues to be in a downward slide. So we always want to focus on bigger picture concepts. So big picture concepts, we just saw the CPI. That was the other big market mover in the week. Still more to come, but CPI is your inflationary data. A year ago to present, it was, again, this is where markets work. The expectation was 7.3% of inflation, and we actually got a 7.1, and the market went wild. Nonetheless, don't forget that we still have a 7.1% annualized inflation rate, and the Fed will continue raising rates until that comes even lower. Back to the big picture. We still have the market looking at the S&P futures down, a potential move, not looking for new lows in 2022, and every day that passes is one more day the market's not making new 52-week lows. But that is the trajectory and the assumption that the bear market or the downtrend continues into the new year. So we'll start with that. But on the Federal Reserve, big things have moved. So let's look at our movement. Just a quick note about the bigger picture. There's your Russell, and a kind of a quick look at where we are in the aftermath. Let's actually do this. Let's look at the aftermath in the overnight grid and put that on a 1-minute chart. And what we'll see here is the initial reaction and market movement in the main equity markets, or the main commodity markets too. That being the S&P, gold, crude oil, did not move much on the Federal Reserve, and the bond market. So we all are looking at the 11 o'clock Pacific time print, where the Fed raised their rates. Not a lot of movement in the crude market. It ended the day up about 3%. Gold was taken to the downside, rally reversed, and closed about where it was when the Fed announced their policy change. But then so did the bond market. Bond market sold off, and then rallied to close back about where it started, and almost true in the equity futures. They had the sell-off, they had the bounce back, but ended a little bit lower from the announcement, looking at the announcement only. So where does that take us in the big picture of these markets, starting with crude? Crude has this support level, again, about the 75 or so per barrel level, and we are seeing it right back to it. So that will be our pivot point and our key focal point for trades, being potential bearish for breakdowns if beneath 75. In the meantime, we do see crude with a better shot than not, or better chance to rally and to bounce back above and hold support at 75. So we will go ahead and update that trend line to the present, and again as we go into 2023, with a potential bounce playing for oil. And that would somewhat be true in other ETFs that are similar or related to that. Gold, however, is at the middle. And let's start our discussion on gold, which we think of as an inflation-sensitive commodity, but hasn't really been the last few years. When inflation has surged, gold at best remained sideways, or at worst went lower. Now gold has just completed the midpoint or mean reversion back to the middle of our target, and that is just about the 1800 per ounce level, which is an established level since mid-2020. Think about it as the midpoint or the value where the gold market is fairly priced. It's fairly priced, again, monthly and weekly charts, around just above 1800. It is unfairly expensive. Think of it as overbought or a little more expensive when it is nearing that 2000 per ounce level or price. It has been rejected not once, not twice, but thrice from 2000. And the lower support, think of it, the word cheap is probably not the right word, but expensive and cheap, or overvalued, undervalued, to be a little more appropriate, but cheap or inexpensive, under fair valuation being 1800, when it's down near 1700. So a good spot to go long and get a reversal back into the middle for gold. And on the daily chart, we would miss some of these details and some of the targets, but gold is neutral, given that it has returned to fair value. No trade off of that logic. Gold prices, or GLD, would do something similar. So calls or bull or bullish type of plays, and the pricing of the GLD is up away from roughly 150, 155. It's achieved a target into 170. So again, that is complete. Same logic for GLD, and a little bit similar for silver, which has had a little bit more of a downside move in 2022. And that would be true again for the futures contract for SI. That is a bright box, but it is a sideways trading range that does keep us bound, for silver at least, 28, 29 per ounce, 18, 19, 20, but that midpoint is right where the price trades. Trades right here at about 24 per ounce for silver. The bond market, on the other hand, has been down weaker. 2022 has been a story of how weak the bond market got in the same context of how strong interest rates got. And again, the Fed is raising rates to combat inflation to the extent that they raise the Fed funds rate, the overnight rate. They don't control the 10-year, they don't control the 30, they don't control anything of the yield curve. But if rates are generally being raised by the Fed, then rates on the yield curve will generally rise. And that has taken place to the bulk of 2022 as a means to combat or pull back some inflation. And we will certainly see how that plays, but that is the main thesis or theory or narrative of 2022. Inflation is a big deal. Rates, the Fed is raising rates. Rates are going up, and the bond market as a resource is going down. But we have had that pullback again on the thought that the Fed's going to moderate or slow back their rate increases, and that is what they have done. So the bond market got a similar lift to what we saw earlier in 2022. But the main question going forward and back into, or straight into 2023, is what happens next. So will it be a similar type outcome where the bond market goes off and makes new lows? That would be the trend and the probability, because rates are still going up. Inflation may be coming down, but it's still high. And the Fed is not stopping rates. They are still raising them, just at a smaller pace. So that's what we're watching as we begin 2023. Or will this time be different? This time be different, meaning that's it. That's the bottom. And we are trading to the upside for the bond market. And one more quick look at the dollar index, which has pulled back sharply on the same logic. 2022 has been strong for the dollar, strong for UUP and other dollar-denominated markets or assets. But we see the pullback. Same logic going for the bond market. If the dollar and other central banks are raising their rates, so that does put a little pressure that wasn't there earlier in the year. Of course, the currency markets are interest rate sensitive. And with the Fed pulling, they're still raising rates. Don't forget, they're still raising rates, but at a little slower pace than before. And that has allowed the dollar to come out, or steam come out of the dollar just a little bit. On the daily chart, that is a big break. And on the weekly chart, it just shows a deep pullback. So speaking of stocks that are beyond the pale, and a quick update as we finish the video looking at the scans, These stocks just made new 52-week highs in today's session, and there are 2 stocks that made new 52-week lows. And a quick glance at them: Merck, General Mills, PC, and E will be the ones to discuss on a quick end of video basis to look at on a future date. So those quickly would be MRK, and my thought process is that which is strong tends to get stronger. General Mills, GIS, a consumer defensive or consumer staple, and PG and E. There are 2 stocks, however, that made in today's session, with all the volatility, all the headlines, all the Fed, new 52-week lows. One of them is a familiar name, Tesla. Tesla broke 2 new 52-week lows after making another bear flag and trade sell side activity, taking any profits down here on the short side into new lows. But not just Tesla. AAP, which is Advanced Auto Parts, similarly weak getting weaker, downtrend getting downtrendier. And if this continues and starts to get to broader stocks, Amazon and other technology companies not too far away from their 52-week lows as well. As always, be careful and safe. This is Corey Rosenblum with tonight's TheoTrade video update for December 14th, 2022.